Hey guys, welcome back to the channel where we teach you all you need to know to become a consistently profitable trader. In this video, I will be going over a RSI divergence strategy that I have been using for some time now and that I have seen great success in. So most people watching this video should be aware of the RSI indicator, as it is one of the most popular trading indicators. Just to give some history, it was developed by J. Willis Wilder and it is used to analyze the strength and momentum of a price movement. The RSI oscillates between 0 and 100 and it can help to determine areas that are either overbought or oversold in a particular pair. So how does the RSI work? RSI calculation. The RSI is calculated based on the average of the gains and losses over a specified time, typically 14 periods. However, you can adjust depending on your preference. For this strategy that I am using, it is actually left at the default, which is 14, and all the settings are left at default. Overbought and oversold levels. RSI values above 70 are considered overbought, indicating that the currency pair may be overvalued and a potential reversal or correction could occur. In contrast, when the RSI is below 30, it is considered oversold, indicating that the currency pair may be undervalued and a potential upward correction or reversal could occur. Divergence. Traders also use the RSI to identify divergence between the indicator and price movement. For example, if the price is making higher highs, but the RSI is making lower highs, it could be a possible reversal. RSI and trend confirmation. RSI can also be used to confirm trends in the market. In an upward trend, the RSI tends to stay above 50, while in a downward trend, it tends to stay below 50. RSI crossovers. Some traders also use RSI crossovers with certain levels to identify entries and exit points for trades. Now that we have a pretty clear understanding of how the RSI works, let's jump right into our strategy. The first thing we're going to need to do is to get the RSI indicator added to the chart. So we're going to go ahead and head over to Trading View, select the Indicators tab, then type RSI, and the first thing that pops up should be the Relative Strength Index. Now that we have the indicator on our pair in Trading View, we will look out for a few things to identify a potential trade setup. The first thing we're looking for is the RSI crossing the overbought or oversold area. So we're either looking for it to go above 70 or below 30. So whenever we see this purple line go above 70, that signifies that it is overbought. And of course, when we see it go below 30, that signals that it is oversold. And of course, you can just go ahead and hover over the candle to see the exact number the RSI is at for increased accuracy. There is a common misconception that states that whenever the RSI is in an overbought or oversold position, it is almost guaranteed to reverse in the opposite direction, which is definitely not true. So what we're going to want to do with the first overbought or oversold position is to compare it to the next move that the market will make. So let's go with a bullish example to give some context. Let's say the market makes an impulsive move and the RSI pushes past the 70 mark. We're not going to trade now that we have a overbought position. What we're going to do instead is to give the market some time to retrace, and if it happens to make a higher high than the previous high with a lower RSI level, we do have a potential trade setup right there. The divergence shows that even though the market is pushing higher, there isn't a lot of momentum to sustain the price, which will eventually lead to a reversal. We want to ensure that we are able to confirm the reversals, so we would not trade until we see another factor, and that factor would be 2 consecutive bearish candles. So I am going to go ahead and show you some examples later down in the video, and of course these setups will be a lot more successful combined with other confluences such as candlestick patterns and volume spread analysis. I do have a video of that which will be linked in the description. You can go ahead and check that out afterwards. Alright, so let's jump right into the first one. And one thing that I do usually recommend before trying out any strategy is to ensure that you have sufficiently backtested, just to ensure that it works on your pair as well as the time frame that you are most comfortable with. Now, we have drawn up a little zone right here because what we do usually use to determine our take profit level is usually a supply or demand zone. So let's go ahead and see how this one plays out. Let's go ahead and push it forward. So as you can see right here, the market just broke out of the RSI level, the RSI overbought level. Currently it is at 79, well exceeding the 70 mark. So let's see how it plays out again. Okay, so now that we do have the first confirmation, which is the first, I would say, first wave breaking out of the overbought or oversold zone, we're just going to go ahead and give the market some time to restructure. So let's see how that goes. And as you can see, it did fall a little bit. And then we're going to go ahead and wait for it to make a new high, since this is a bullish move. So as you can see right here, the market did make a new high. Right here it is higher than the previous high. However, if you check the RSI level, the RSI is lower than the previous RSI level, which means that there isn't a lot of momentum, which signals a reversal. So let's go ahead and see how it plays out. Okay, and that right there is going to be our confirmation. So once we go ahead and see that, and we see two bearish candles right here, we have two red bearish candles, that is usually our signal for entry. And of course, what we're going to go ahead and do is to open a short position right there at the close of the previous bearish candle, and we're going to go ahead and put the take profit level at the either the supply or demand zone, and we're going to go ahead and put the stop loss level a few pips above the previous high. So let's go ahead and see how that plays out. Okay, so just a few time has passed, and as you can see right here, the market did come right back right here to that zone that we marked earlier, which of course was our aim, and that would have been a 2.28 risk to reward ratio, and that would have been about a 29.6 pip win. Alright guys, that is it for the video. Thank you so much for staying to the end. If you learned anything, please be sure to drop a like and hit that subscribe button to ensure that you don't miss out. This is one of my main strategies currently on the Euro USD pair, where I trade lower time frames, so I hope that you will learn something. See you next time.